Welcome back to The Deep Dive, the only place where we really break down the earnings call so you don't have to. Today, we're jumping into Post Holdings, Inc., ticker POST. Their Q4 fiscal 2025 call was a really interesting one. The numbers look fantastic, but the market just panicked.
That's the whole story right there, this tension. The results came out. We heard from CEO Rob Vitale and his team on Friday morning. And look, they delivered a big beat. But the stock ended the day down over 7% on heavy volume. So our mission today is pretty clear. Figure out why the market saw a great report and just ran for the exits.
Let's start with those headline numbers, because on the surface, they look incredible. Adjusted diluted EPS, $2.09.
Right, and consensus was what, like $1.92? So that's a solid beat, almost 9%.
A huge beat. And then you look at adjusted EBITDA, it's up 22% year over year, $425 million.
And sales were basically flat to expectations. So if you just look at that, you'd think the stock would be soaring. But we need to get to that friction point right away.
Yes, exactly. If they beat on profits and EBITDA, why did the stock hit a near 52-week low? What was going on under the hood that spooked everyone?
Well, the first clue is in the reported GAAP earnings, the official number. Diluted EPS was only 88 cents. And that was actually way down from $1.28 the year before. The big reason for that gap was a non-cash charge, a goodwill impairment of about $30 million.
Okay, let's pause right there. Goodwill impairment. For our listeners who aren't, living in balance sheets, what does that actually signal?
It's crucial. Goodwill is basically the premium you pay for a company over its physical assets. You're buying the brand, the customer relationships. When you impair it, you're officially saying on the books, hey, we don't think the future cash flows from this business are going to be as high as we thought when we bought it.
So it's basically an admission that they either overpaid or the market for that specific business was a cheese and dairy.
Cheese and dairy, yeah.
That market has gotten structurally worse. So even though it's non-cash, it's a huge red flag about the future.
A massive red flag. And that, plus the guidance, which we'll get to, is why the stock dropped 7% on more than 3 times the average volume. The market looked right past Q4 and priced in future problems.
All right, so let's dig into the segments. Let's start with the one part of the business that's absolutely on fire, food service.
Explosive is the only word for it. Net sales up over 20%, underlying volumes up 9.3%. And here's the kicker, the profit, the adjusted EBITDA. It surged almost 50%, to $161 million.
And a 50% jump in profit is just wild. So how much of that is real sustainable demand and how much was just, a lucky break?
It's a mix. The sustainable part is real demand for their value-added egg and potato products. Management talked a lot about operators switching to liquid eggs for efficiency. But a huge chunk of that margin boost came from HPAI pricing.
The avian flu.
The avian flu. The supply crunch just let them charge way, way more for their cold chain products.
Okay, but that's the big question, right? That pricing isn't permanent. When it normalizes, how much of that 50% EBITDA growth just evaporates?
That's the million-dollar question. Management's argument is that the customers are sticky. Once a big kitchen switches to liquid eggs, they don't switch back. But the market is clearly betting that a huge piece of that profit windfall is temporary and it's going to vanish pretty soon.
Which brings us perfectly to the segment causing all the anxiety. Post-consumer brands, or PCB. The sales number looks okay, but that's just because of an acquisition. The legacy business. Yikes.
Yeah, this is where you really see the consumer getting squeezed. Cereal volumes, their core business, dropped 8.1%. And pet volumes were even worse, down 13.2%. They lost some nutrition private label business. It's a tough scene.
When you see your core volumes fall 8 and 13%, usually your profits just fall off a cliff. So what happened there?
This is the really impressive part, and it's easy to miss. Despite that massive volume pressure, they actually expanded PCB's EBITDA margin by 100 basis points if you exclude the acquisition.
How on earth did they pull that off?
They chose margin over volume. Simple as that. They focused on selling a better mix of cereal, higher margin stuff, and they were really disciplined on costs. They've been closing plants, which is a permanent improvement to their cost structure. It's a smart way to protect profit in a shrinking category.
But it's risky long term.
Right.
You protect profit today, but you could be giving up shelf space and market share that you'll never get back. And real quick, refrigerated retail.
Same story as food service, really. EBITDA was up big, over 44%, mostly because of that HPAI pricing. But their core volumes were down 4%. Consumers push back on the higher prices for sauces and eggs. That's elasticity.
So the picture is, profitability is high because of temporary pricing, but the retail volumes are shrinking. This puts all the focus on how they're using their cash. Let's talk capital allocation.
This was a huge theme on the call. They are incredibly disciplined. They generated nearly $500 million in free cash flow this year. And even with some big acquisitions, their net leverage stayed flat at 4.4 times. They're built to be a cash return machine.
And nothing screams that louder than the buybacks. They were unbelievably aggressive.
I mean, they retired over 11% of the company's shares in 1 year. They spent over $700 million buying back their own stock. And they bought another million shares after the quarter ended.
So CEO Rob Vitale is essentially saying he thinks his own stock is the best investment out there.
He said it explicitly. He said any M&A deal they look at is benchmarked against the risk return of just buying back their own shares. The buyback isn't just something they do, it's core policy.
And the portfolio moves fuel this. They buy a company like 8th Avenue, but then they immediately sell off the parts they don't want, like the pasta business.
Exactly. They just announced the sale of the pasta business for over $350 million in cash. That's expected to close in Q1. And that cash goes right back into the Treasury to fund. Guess what? More buybacks. It creates a structural floor under the stock.
You also have to connect this to the leadership change.
Yeah.
Vitale is taking over as chairman in December.
Right. It just solidifies the strategy. The guy driving the capital allocation decisions is now consolidating power. It means this acquire, prune, buyback machine is going to keep running at full speed.
Okay, let's get to the heart of it. The real reason the stock dumped. The guidance. It's not about the past, it's about the future.
It is all about the guidance. The full year number, 1.5 to 1.54 billion in EBITDA, that's only 1 to 4% growth. It's fine. But it's the shape of the year that created total fear. Management warned, and they were very direct, to expect a meaningful decrease in Q1 EBITDA.
A meaningful decrease, coming right off a huge Q4 beat. Why the sudden cliff dive?
It's the hangover. Two things. First, those HPI pricing benefits in food service and refrigerated retail. They're gone in Q1. They completely normalize. And second, they're expecting a seasonally soft quarter for cereal sales in the US and UK.
So Q4 was the party, fueled by the bird flu crisis, and Q1 is the brutal morning after. The market hates that. It hates near-term uncertainty after a sugar high.
Exactly. The entire full-year plan relies on a big comeback in the second half of the year. Investors have to trust that they can stabilize volumes and that food service is still strong without the pricing windfall. That's a big ask.
All right, time for our final segment. We take all this conflict and confusion and pitch a wild but plausible trade idea. As always, this is for entertainment, and this is not financial advice.
Look, the setup here is a perfect storm of divergence. The market is pricing in absolute panic about Q1. Total fear. But what is management doing? They are screaming from the rooftops that their stock is cheap by buying back 11% of it. And they have $350 million in cash coming in the door.
So the bet is on management's actions, not the market's fear. How do you play that?
You initiate a short volatility trade. You go out to, say, Q2 of 2026, and you sell an out-of-the-money put option, maybe at a $95 strike. The fear in the market means the premium you collect for selling that insurance is really high right now. Then you immediately take the cash you just collected, the premium, and you use it to buy common stock today.
Wait, so you get paid to promise to buy the stock near its 52-week low, and you use that free money to buy shares right now while everyone else is panicking.
You got it. You're using the market's own fear to fund your entry position. And you have that $350 million in cash and the ongoing buyback creating a very strong floor right around the current price. You're selling the panic to buy the long-term value that management is so clearly signaling.
That is a clever way to play it. So what's the big takeaway here for the long haul?
The takeaway is that Post is managing a tough retail environment with real discipline. They're protecting profits, and they are funneling cash back to shareholders. But the whole investment story for you, the listener, it all comes down to whether you can stomach that Q1 dip they've warned you about.
And the final thought is this. Management is promising that free cash flow is going to get even better in FY 2026 because they're spending less on capital projects. So the question you have to answer is, can they deploy all that cash fast enough to prop up the stock before the weakness in cereal and pet food does more damage? That's the dot you need to connect.
That's it. It's a race between cash flow and category decay.
Thanks for joining us for this deep dive. We'll catch you on the next one.